Guys, this is serious. Mortgage rates just topped 7%, which is the highest that we've seen since October. And before that, the highest that we've seen in 20 years. Check this out.
Well, Kelly, the 30-year fixed just crossed over 7%, 7.1% to be exact, according to Mortgage News Daily. Take a look at this roller coaster over the last several months. Rates went over 7% at the end of October, which immediately caused home buyers to pull back pretty dramatically. Then in December, they started coming down again, all the way to 6% by January. That caused a big jump in buyers in January, signing contracts on existing homes, so-called pending home sales, up an unexpectedly strong 8% month to month. But the past 4 weeks, they have been rough. Rates have moved 100 basis points higher since the start of February. So if you're buying a $400,000 home with 20% down on a 30-year fixed, your monthly payment is now roughly $230 more than it would have been just a month ago. We've already seen mortgage applications from home buyers drop dramatically last week to a 28-year low. So we thought at the start of this year that the housing market was beginning a recovery. It appears that recovery has now stalled. Rising fears that inflation is not getting in check is pushing bond yields higher, as you all know, and mortgage rates right along with them. Kelly?
Wow. I can't believe how much we've come full circle on that. Diana, real quickly, what was the high last year we hit on the mortgage rate?
It was 7.37% at the end of October.
Okay. All right. Diana, thank you. Diana Oleg.
What do you guys think? Can you afford any sort of housing right now? Let me know just a little bit of your housing situation in the comments down below. I mean, this really just totally wrecks any first-time home buyer's hopefulness. Just comparing it really quickly here, on a $400,000 home with a 20% down payment on a 30-year fixed rate loan, the mortgage payment, including principal and interest, is roughly $230 a month more than it would have been a month ago. That's just a month. And compared to a year ago when rates were in the 4% range, today's monthly payment is about 50% higher. Plus, the people who got a 3% mortgage a few years back, like me and my family, they're not going to want to sell, so that tightens up the housing market even more. And we're not even counting the impact the probable recession is going to have on this whole equation. So the question is, will this recession create a housing market crash, or will we be spared? Are we looking at another situation like 2008? Let's review the data and update our real estate market analysis from March 2023. Some experts say that the Fed has no choice but to push the United States into a hard landing recession to pull inflation down. And so this means layoffs, even possible bankruptcy for millions of Americans. Now, I want to give you guys updated information, and then we can talk about the future predictions. Plus, I got some pretty interesting stocks to look at. Recession-proof market bets on Wall Street. Definitely stay tuned for that one. But before I continue, please take a second, drop a like for the video. I totally appreciate that. That also helps out with the YouTube algorithm. And if you're in need of your daily dose of the truth when it comes to the housing market, the stock market, the economy, Social Security, SSI, SSDI, and everything that's going on in Washington, D.C. that affects our lives, our families, and our bank accounts, be sure to subscribe to the channel. And if you own a home, make sure your home is protected. Get your free home warranty quote. There's a link in the description down below this video, guys. It only takes like 15 seconds. Guys, so we just topped 7% in the mortgage rates. This is the highest that we've seen since October. But I don't think that's really stressing it enough, because before October, we virtually didn't see a mortgage rate of 7% in like 20 years. And you know what happened about 20 years ago? The housing crisis that led to the Great Recession. I mean, it's pretty much just one thing after another. Is history going to repeat itself this time again? So first, inflation running a 4-decade high, then the Fed basically slamming the brakes on the economy with rate hike after rate hike. Now, I don't know about you guys, but I definitely feel like I'm running to stay still, if you know what I mean. Monthly mortgage payments are 75% higher than a year ago. And as a result, prospective first-time home buyers have lost about $100,000 in purchasing power and have been essentially locked out of the housing market. Now, if you're a first-time home buyer forced to wait on the sidelines until the housing prices and mortgage rates fall, experts suggest that you make the most out of this time to manage your money wisely, especially given the likelihood that we're headed toward a recession. They suggest getting an extra roommate just so that you can have a little bit more of a financial cushion and that you're not living paycheck to paycheck, putting so much money toward housing. They also say that right now is a good time for people to make sure that they have the cushion that they need and that they're putting money toward their emergency fund, because the economy is likely going to turn more sour as we fight this inflation. End quote. But really, guys, I feel like most of us are already pretty full up in our living situation. I mean, am I right? I mean, just putting this out there, a lot of people can't really afford anything right now. They got to do something. Housing and rents, they have to come down. Hit the like button if you guys agree. Now, I just want to take a moment and recall what I've been telling you guys about this. We saw a bit of a recovery when housing demand picked up a few weeks back. All the mainstream media channels, even other YouTube channels, they got really excited and said that there's not going to be a recession. The United States is going to have its cake and eat it too. Blah, 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 all that stuff. But here on this channel, we knew the truth. I told you guys, it's probably going to be a bleep and, things are going to come crashing down again pretty soon. Yep, and you guys stuck with me. And here we are right now proving that we were right all along. I mean, just look at what's happening. Mortgage rates just topped 7% for the first time in virtually 20 years. Mortgage applications from homebuyers have been falling. In fact, it hit a 28-year low just recently, according to the Mortgage Bankers Association. And at the start of the year, with rates slightly lower, it appeared the housing market was starting to recover just in time for the traditionally busy spring season. But that recovery is now stalled, and rising rates are only part of the picture. It has to do with the economic situation right now, and quite frankly, what you guys have been telling me all along. Yeah, you guys have been telling me this. Everything's just downright unaffordable right now. Now, according to economists over at Realtor.com, quote, consumers have taken on record amounts of debt, including mortgage payments, personal, auto, and student loans. With rising interest rates, financial burdens are expected to increase, making consumer choices more difficult in the months ahead, end quote. Now, will all of this mean a 2008-style housing crash? Well, there are a lot of factors to consider, but really, I don't think that home prices will fall too dramatically, as the difference from 2008 and before to today is that a record amount of single-family homes are owned by institutional investors. These are large investment firms that will create a floor of home values to protect their existing investment. What kind of firms am I talking about? Well, it could be anywhere from Bank of America to BlackRock to Open House to Zillow, you name it. Blackstone. Plus, let's not forget about all the people who locked in those sweet sub 3% mortgage rates a little while back. So here's the housing landscape right now. Higher mortgage rates triggered a drop in demand. Meanwhile, homeowners who've locked in lower mortgage rates are choosing not to sell, which tightens available inventory. And so that means that the market is losing buyers looking to move up, and they're losing sellers that are looking to move up as well. So this kind of lock-in effect is making things hard for both sides of the market. Taking a look at production, it says here that even if every single family home under construction right now was completed and listed on the market immediately afterwards, the month supply of homes would still be below historic averages, despite the current pipeline of new homes under construction being historically large. Now, according to Goldman Sachs, 99% of borrowers, they have a mortgage rate lower than 6% or the current market rate, and about 28% of those rates are below 3%. Think about it like this. If you took on a $600,000 mortgage and your rate was 7%, your monthly principal and interest payment will be $3,992. But with the same size loan and a rate of 3%, your monthly payment is slightly over $2,500 a month. Huge difference. I just really want to drive the point home and reiterate this. 7% interest rate, mortgage payment is like $4,000. 3% interest rate, your mortgage payment's $2,500. That's a $1,500 difference. And that's only 4% in difference in mortgage payment rate. So one quote that I got from a finance and economics professor over at University of South Alabama, he said this: "We just think that we'll have to ride it out, and hopefully in the next 12 to 18 months, the market will move down," end quote. So it seems that the inventory will stay tight, and we might see greater declines in the housing supply as 99% of borrowers that have rates that are below the current market rate hold on to their old rates. It makes sense. U.S. home prices have fallen 16% in San Francisco, which is the largest drop in the United States since the post-C-19 pandemic peak back in mid-2022. But prices are still up 38% nationally since February 2020. But really, I think that a big part of what's going on is going to depend on how high mortgage rates go. Buyers really can't do much because of low affordability, and sellers really haven't wanted to budge much on their price. I mean, can you blame them? I mean, given the majority locked in and historically low 30-year fixed rates at slightly above 3%, those low fixed rate mortgages, they can provide these home buyers with a big cushion to be able to ride out the storm, even if the Fed's policy rate is going to be raised above the 5% that we're currently committed to. Layoffs are going to have a major impact. The economy is basically a minefield right now, but there are some ways to make money here. And who said money can't buy happiness? Money grants happiness. It's all about how you deal with it. Can I get an amen, guys? I think what we really need to keep in mind is that the Fed now has probably no choice but to push the United States into a hard landing recession to pull inflation down. Now, I've read one stock strategist comment that they think the Fed is going to feel the pressure to continue to hike, end quote. So data is likely to keep coming in hot because Fed rate hikes work with a lag, and it takes 12 to 18 months for the full effect of Fed tightening to be felt in the economy. And rates have already reached a restrictive level in December. Though central central bankers have cited a still hot economy as a reason why interest rates need to move higher. Markets are expecting a 25 to 50 basis point rate hike in March. And when all is said and done, experts predict a final rate of 5.25 to 5.75% this year, up at least 75 basis points from the current target of 4.5 to 4.75. I mean, Jerome Powell and the Fed officials, they're not probably going to be pausing or cutting interest rates until prices start to near that 2% inflation target, which could take until the third or even fourth quarter of 2023. Some articles I read said that this could take up to 2026. Other Wall Street commentators have warned about the Fed over-tightening the economy as interest rates edge higher. BlackRock's investment chief said central bankers were willing to push the economy into recession after being too lax on inflation last year. And 75% of economists in a Bloomberg survey said that they expected the Fed to spark a recession within the next 2 years. So better be prepared, guys. One way I thought of doing this is to look into some recession-proof stock ideas. Now, firstly, it's important to note that no stock is completely recession-proof, as economic downturns can impact pretty much every sector of the market to some extent. But with that being said, some stocks do typically tend to perform a little bit better during recessions than others. That's why market experts call it defensive stocks. Consumer staples is one of them. Now, think of companies that produce essential products that people are going to need regardless of the state of the economy, such as food, beverages, household products, personal care items. Examples of staple stocks include companies like Walmart, ticker symbol WMT, Coca-Cola, ticker symbol KO, and Procter & Gamble, ticker symbol PG. Now, I mean, people got to have their essentials, right? And speaking of essentials, there's also recession-proof stocks in utilities. Think of essential services like electricity, gas, and water. Nobody's really trying to go without these things, which people and businesses, they need this regardless of the economic conditions. Now, some utility stocks that you guys could check out are Next Era Energy, ticker symbol NEE. You've got Dominion Energy, ticker symbol D. You've got American Water Works Company, ticker symbol AWK. Now, the other cool thing about these utility stocks is that a lot of them pay actually pretty good dividends. So if you're trying to generate some passive income, this may be a good place to start looking. Now, of course, do not forget about healthcare. Now, with the economy taking a nosedive, people are probably going to be needing some medical care even more. You know what I'm saying? Companies that specialize in pharmaceuticals, medical devices, healthcare services, these might be good options. Now, some examples of healthcare stocks that you could check out are Johnson & Johnson, ticker symbol J&J, Pfizer, ticker symbol PFE, and of course, United Healthcare Group, ticker symbol UNH. Now, finally, considering investing in companies that, produce or sell consumer discretionary items that are relatively affordable or cater to loyal consumer bases. I mean, people are still going to say, hey, I deserve it, right? Even if it's just indulging in some small luxuries throughout these tough times. Time after time, recession after recession, companies that provide entertainment, leisure, or retail items that are deemed necessary luxuries, they tend to do well. I mean, like when the chips are down, people turn to stocks like McDonald's, ticker symbol MCD, Target, ticker symbol TGT, and of course Netflix, ticker symbol NFLX. Y'all know what I'm saying. Now remember, investing in stocks, it always carries some level of risk, and there's no stock that's entirely recession-proof. Just make sure that you do your homework and you bank on companies that have great, stable cash flows, strong fundamentals, and a history of weathering economic downturns. Heck, I'd be staring at the dividend aristocrat list, if y'all know what I mean. And if you don't know what I mean, definitely hit me up in the comments down below, and maybe I'll do a dedicated video on that one. But this is just like one of the ways to add onto your income streams. Let me know if you guys want to talk more about any other ways to boost your cash flow, like creating side hustles or maybe even starting a small business. Yeah, we could totally get into that in a future video. Just hit me up in the comments down below. Let me know what you're thinking. For more updates on that and all of the other ways to make money in my future videos, guys. And if you're interested in the best way to invest in gold, definitely hit the link in the description down below of this video. I hope you guys caught all the information in today's real estate update and daily news report. The real estate landscape right now, mortgage rates are topping 7%, and some of the recession-proof stocks that you guys could look into. Scary stuff out there, guys, but still, appreciate you guys watching. Please be kind to one another. Thank you for dropping a like for the video. I really appreciate the love and support. I'll see y'all on the next one.